Hey all, welcome to ShareTreck where science meets investments and I'm your host Raj. Friends, today we are looking at a presidency that's blurring the line between government and entertainment. In 2025, Trump is back in the White House, but instead of stability, we are getting a reality show, complete with drama, cliffhangers, and abrupt policy twists. But this isn't just political theater. These decisions are shaping the global economy, American economy, markets, and America's global credibilities in ways that will outlast the cameras. In this video, we will examine how Trump's tax and spend bill is reshaping wealth and risk, why allies are losing faith in US trade agreements, what tariffs are doing to inflation and consumer spending, and how Trump's latest move, a shadow Fed president, could shake the foundation of monetary policy. Let's start with the fiscal policy. Let's look at Trump's signature fiscal package named the Big Beautiful Bill. It was marketed as a return to American greatness, but behind the branding, the numbers tell a different story. According to Congressional Budget Office, the bill is projected to add 2.8 to 3.4 trillion in the federal deficit over 10 years. That's not just from tax cuts, it's from aggressive new spending with no equivalent offset. Who are the biggest winners of this bill? Well, they are the households earning above $400,000. Corporate tax relief has also stayed intact. Meanwhile, Medicaid and food assistance programs saw deep cuts. SNAP benefits were restructured under new work requirements. Housing and early childhood education grants were slashed by nearly 18%. What does all of this mean in practice? Well, by 2034, about 12 million more Americans are expected to be uninsured. Most of them will be in rural areas and lower income zip codes. A rollback in Medicaid expansion is already being felt in hospitals, especially those in red state counties. The Congressional Progressive Caucus called it a reverse Robin Hood policy. Meanwhile, moderate Democrats in Senate tried to and failed to include protections for veterans and children. And the result is a fiscal plan that enriches the top, squeezes the base, and leaves a $3 trillion hole for the next generation to fill. Trade has always been Trump's playground, and in 2025, it's become even more chaotic. Let's take Canada first. That's where I am from. Remember, Trump had demanded that Canada drop its digital services tax. And then when Canada dropped the digital services tax, Trump publicly praised Canada for dropping the DST. Yet, just days before the final negotiation deadline, he unilaterally announced a 35% tariff on Canadian imports effective August 1st, 2025. Remember, this comes on the back of NAFTA, which was scrapped by Trump and reassembled and rebranded USMCA, which in his current term, he says is a rip-off deal. And he wanted to impose blinding tariffs. And after a whole lot of diplomacy, we had come to an agreement that the DST would be dropped and sincere negotiations will happen with the United States, and Canada negotiated in good faith. And this is what happened, a 35% tariff on Canadian imports effective August 1st, 2025. The Canadian officials were blindsided. Ottawa's trade ministry called it a betrayal of mutual negotiation. If you go further ahead to the east, then there is Vietnam, a textbook example of how unpredictability damages trust. At the request of United States, Vietnam had fully eliminated tariffs on US goods, complied with US digital rules, and Trump claimed victory. Trump even tweeted claiming victory that Vietnam would impose 0% tariffs on US imports. Despite that, and a negotiation which resulted in an understanding of an 11% tariff on Vietnam, they were slapped with a 20% tariff, equal to the Philippines, who hadn't even begun formal talks. What does this signal? This signals that deal making with the US under Trump is meaningless unless it involves direct presidential involvement. And even if there is direct presidential endorsement of a deal, does it even mean anything? Look at USMCA. It has been wiped out. So, trade officials in Mexico, Japan, and the EU are now demanding written Trump letters to verify commitments. This kind of instability cripples global supply chains, especially in semiconductors, rare earths, and pharmaceuticals, which rely on long term cost predictability. Now, let's shift to the domestic fallout within the United States. Tariffs, as always, don't stay at the border. They ricochet back to the American customer. Here's the June 2025 inflation data. Core CPI is running at 3% year over year, and overall CPI is still at 2.6%. What is driving it? Well, there was a lot of front loading imports by many importers in order to avoid the tariff. Now, those inventories are getting sold out. Roughly 70% of tariff costs are being passed directly to consumers, and that will come out in the economic data, according to Bank of America Global Research. JP Morgan estimates that tariff alone are boosting personal consumption expenditures or PCE inflation by 1 to 1.5% this year. That's enough to reverse real income gains and possibly trigger negative consumer spending growth in Q3 or Q4. Economists are especially concerned about essentials, groceries, energy, and medications. Some retailers like Walmart and Costco have already issued profit warnings based on pricing pressure from imported goods. And yet, here's the contradiction. The S&P 500 is soaring, up more than 10% in Q2 and hitting all-time highs. Why? Well, there are several factors. Market concentration is the first one. A handful of mega cap tech stocks like Apple, Nvidia, Microsoft, and Amazon are carrying the index. The second factor is AI-driven trading, which is flooding capital into perceived safe tech. Then we have bond yields anchored, making equities more attractive, at least for now. But beneath the surface, it's uneven. Small cap indices like Russell 2000 are flat. Consumer sentiment is down for 3 consecutive months. Small business optimism fell to its lowest point since 2020. And why is this happening? This is also happening because of phenomenon called as taco trades. That is, Trump always chickens out. So a lot of players, speculators in the stock market are thinking that Trump will eventually back off and there won't be high tariffs. And this is a big risk to take. This has resulted in a bifurcated economy where the Wall Street thrives while Main Street struggles to breathe under rising prices and policy instability. All of this will come home to roost when we start getting earnings results which show a weaker consumer spending and a reduced margin, and the P by E ratios will start to dictate a lower share price. And with inflation still above target and growth uncertain, the Federal Reserve has taken a cautious stance. The Federal Reserve rate remains steady at 4.25 to 4.5%, unchanged since March 2025. The Fed is signaling no cuts until Q1 2026, pending more inflation data. In fact, the Fed chairman had said that if it wasn't for the tariff issues, there would already have been rate cuts by now. But Trump has introduced something truly unusual now. In his fight with the Fed chair, he's introduced the concept of shadow Fed president. This isn't a formal appointment, it's an informal emissary, rumored to be a political loyalist, tasked with publicly advocating for Trump-aligned monetary policies and applying pressure from the sidelines on the Fed. Historically, US presidents have respected the Fed's independence. Even Nixon's pressure on Fed Chair Arthur Burns happened behind closed doors. But this is different. Trump's shadow Fed approach is public, partisan, and destabilizing. It casts doubt on the Fed's decisions, whether they will be data-driven or politically motivated. If investors lose faith in the Fed's independence, we risk unmooring inflation expectations, and that's a nightmare scenario for bond and equity markets alike. And it could also have an impact on the US dollar. Finally, let's look outward. Trump's habit of breaking or threatening to break signed deals has created a reliability crisis. The Paris Accord is a glaring example. The USMCA, signed in 2020 and reviewed every 6 years, is already being weaponized ahead of the 2026 checkpoint. Mexico and Canada are bracing for new demands. Japan, Germany, and Australia have paused new trade negotiations until post-election stability returns after the midterms. Meanwhile, there's another consequence. De-dollarization efforts are gaining steam. India, Brazil, and Saudi Arabia are increasing non-dollar bilateral trade, citing contract integrity as a key motivator. If the US loses its reputation as a predictable trading partner, the dollar reserve status will also slowly erode. And with it, America's ability to borrow cheaply and lead the world economically. And that's the reason why Trump is now threatening BRICS nations with a higher tariff if they were to adopt so-called anti-American dollar policies. Now let's look at this table, which shows the policy area and the outcome that it will produce. And you can see that overall, the bill is going to add 2.8 to 3.4 trillion in deficit. And that's going to be a top-heavy bill because Medicaid coverage is going to be lost by more than 12 million people who are going to be uninsured by 2034. And the 35% effective tariff from August 1st on Canada is also going to add to the tariff-driven inflation, and it's going to push up the core CPI because all the inventory that was stockpiled before the tariff came in is all running out, and the new inventory which is coming in has got higher tariffs, and 70% of that tariff is being passed to the consumers. So that's going to lead to some amount of inflation. And in the meanwhile, you are seeing the market performance is like phenomenal. We have S&P 500 almost at all-time highs. But remember, the 30% of tariff that is not being passed to the customer is going to reduce the bottom line, and it's going to change the earnings when we get the quarterly earnings release. And also it's going to add to the inflation when we get the next set of economic data, which is not visible right now. So when all of that happens, it's going to be a rug pull, in my opinion. It's also led to the Federal Reserve Chair losing his credibility to a good extent, and also global trust between trading partners has gone down. Market breadth is thinning, inflation is rising, and political volatility is pricing in greater tail risk. This is a market floating on confidence and momentum, not fundamentals, in my opinion. I would like to hear from you what you think about that. With regard to retirees and income-focused investors, rising inflation is especially dangerous. If real returns on fixed income remain compressed while prices continue climbing, your purchasing power deteriorates. And with cuts to Medicaid and other safety nets, retired Americans on tight budgets could be forced to dip into savings much faster than planned. Now, for foreign investors like myself, and also the bigger ones like sovereign wealth funds, central banks, and multinationals, there's a deeper risk at play: trust erosion. If the US is seen as an unreliable negotiator or prone to policy whiplash, long-term investments, especially in infrastructure, supply chains, and real estate, will become harder to justify. This isn't just about tariffs, it's about confidence in governance. And the US has long been the global financial safe haven, the place where rule of law and institutional stability made it worth the premium. The word of US used to be something that could be taken to the bank. That premium is now at risk. This will manifest in a weaker dollar and higher yields on bonds, which in turn will take money out of the stock market eventually. Friends, I would like to hear from you, our audience. Do you share my views, or if you have a different perspective, please let me know them in the comment section. Thanks for watching this video, which happens to be my Saturday editorial. If you liked it, please do not hesitate to press the like button, as it helps the channel. And if you are not yet subscribed, can you please subscribe and help me grow the channel? Thanks, and have a great day and a wonderful weekend. See you soon. Bye for now.